Public Trust Advisors welcomes you to this presentation. This is something that we do for most of our clients on a monthly basis. For those of you who don't know Public Trust, we basically work with municipal entities only to help them manage their cash flows, to help them work with their operating budgets, and basically be able to earn additional yield and on the cash that you guys are sitting on. So that's our business. And so the deck that I'm providing here kind of talks about what's going on in the economy as it relates specifically to our investment methodologies, which is basically looking at what the Fed does, how are they modifying rates, what are economic implications for raising of rates, and what are some of the the reasons why yields are so low. So I'm going to go ahead and get started here, and please feel free to ask any questions as you see fit as they come up. So the first thing we're going to talk about today is the three macroeconomic themes that are kind of present right now, specifically being the debt ceiling debacle, as you all know, inflation, whether or not it's temporary or persistent, and what's happening with the Federal Reserve with regards to the stopping of their asset purchase program, where they're purchasing $120 billion a month worth of debt securities in the open market. As it comes to the debt ceiling, this was just passed a couple weeks ago, about a week ago. The government was basically running out of money, was no longer allowed to issue debt because they had hit their ceiling. So Congress met, they've raised the debt ceiling by $480 billion, which sounds like a pretty large number. However, that's really only about 2% of the limit being increased. So this temporarily de-escalates concerns about the default of the U.S. government. However, they have until December 3rd to put something more in place that would kind of shore up their ability to issue debt and keep their ratings as high as they currently are. Inflation numbers, unfortunately, are not turning downwards, and we are going to go through that a little bit further along in this presentation. The real issue with that is, as inflation goes up and rates do not respond, we have a thing called stagflation, which is where rates are increasing but economic activity is not, which can be pretty dangerous for the economy if it remains for an extended period of time. And again, the Federal Reserve taper talk is a persistent issue. When does the Fed stop buying assets in the open market? And if they do, what happens to the liquidity of the market? Again, we are in a very liquid situation overall as an economy due to the recent stimulus money and the printing of dollars for all government expenditures. So it'll be interesting to see what happens over the next couple months with this. So as we all know, we've been living with COVID for the last, I don't know, is it 19 months now? It seems like it's been 6. Sometimes it seems like it's been 26. But as we see here, what we're looking at is a chart of all COVID cases since March of 2020 up until, I believe it's September or the first week of October of this year. So what we're seeing is obviously the big spike that happened in December of 2020, massive economic shutdowns. The entire economy basically halted, and we see those numbers spiking until about March or April, where we had vaccinations start happening. There was the weather turned a little bit better. People were not trapped inside, not seeing each other as closely, or being outside at least, and giving some social distance. And everything was looking like the market was going to continue to recover, and stock market was hitting all-time highs, and then the Delta variant came across. As we see here in June, you start seeing those numbers in the UK, we start seeing numbers like that in the United States. And again, you can see the rise up of COVID cases towards the latter part of this quarter. So we did start hitting peaks again, similar to December of last year. So the big concern there was, what was the impact of that shutdown or secondary shutdown or slowing of the economy because of those cases and mandates that were put into effect. The markets, the economy, and society in general are struggling to put the pandemic behind us. With all the help that the Federal Reserve is kind of, supporting the economy right now. But we'll look and see what happens going forward if these case numbers do not drop. So we're going to start looking at some of the things that our portfolio managers look at when they're looking at doing economic forecasting, expectations for yield for your portfolios, et cetera. What this chart here is the gross domestic product of the United States year over year. We're starting back in 2014. And if you look from 2014 to basically 2019, the US economy is growing anywhere from 2 to 3%. Pretty standard, that's kind of a sign of a maturing economy. No huge numbers, no 7%, 8%, 9% numbers, which is what you're going to see in some emerging markets and so forth. The real highlight here is if you look at the drop from 2019 to 2020, right? We saw a 3.5% drop in GDP in 2020. As all economists thought, the recovery, the shortened depression of the market, the quick drop in assets, then you see a highlight of expectations of the third quarter to grow, of 2021 to grow at about 6%. So those numbers give us a little bit of pause because those are expectations for what's going to happen in the economy, and clearly we're not seeing that. In at least, and especially in the fixed income and debt security markets, it's just not happening right now. So one of the real big concerns, obviously, has been supply chain disruptions due to the COVID pandemic. There's not enough parts to make the number of cars that people need. There's not enough chips to make the cars. There's not enough, chips to make video game systems. So basically, the supply chain shortages are really causing the GDP to drop down. What we can look at on the future slides here is a little bit of where we're going to be, what we're going to expect, and what we can expect for the money earnings rate that we're getting on our cash. To highlight slightly the impact of the Delta variant, this chart here is the Atlanta Fed forecast in real time. And then when I say in real time, it's as the quarter progresses, we're seeing what the Fed members believe the GDP number will be. So if you look at the beginning of the quarter, this starts as of June 30th on the far left-hand side. And what we're seeing at the beginning of June, or the beginning of July, we thought the economy was going to grow at about 8% annualized for the third quarter. As the Delta variant continued to rampage through the United States and the world, we start seeing these numbers start to drop. In the middle of July, we're down to 7.5%, and in August we're looking at 6%. End of August we're looking at 4%, and as of October 10th or October 8th, we're looking almost at 1.3%. That is a very, very drastic drop from 8% GDP growth down to 1.3% expectations. That will have an impact going forward. We'll have to see what the fourth quarter will bring for GDP numbers. Hoping that the holiday season will create an economic boost to consumption and production. So the Federal Reserve dot plot. This chart is basically a key indicator of where the Federal Reserve members think the rates are going to go. Now, the rates are important to us and to you because those rates basically define or basically set limits on what you're going to earn on the dollars that are sitting in the bank. So right now, if you look at this chart on the lower bar there, that's the years. Each year is represented by the calendar year end. And on the left-hand side, we're seeing what the implied federal funds target rate is, which basically goes from 0, where it is now, up to 3%, which I don't think we'll see until 2027, 2028, if we do have a robust economy for 5 years going strong. Each one of the yellow dots that is here represents one vote of a voting member of the Federal Reserve Board and what they think rates are going to be. So if you looked at this chart probably about 6 months ago, you would have seen the yellow dots at 2022 would be basically over at 2023. Basically, everyone assumed that rates were not going to move until the end of 2023. Now, with inflation numbers starting to tick up, you're seeing some of those dots move higher. Basically, the economists believe the Fed is going to raise the rates at least one time, or there's a probability that they'll raise the rates at least one time before the end of 2022. And 3 of those members who are not identified other than with a yellow dot believe that there will be 2 implied rate hikes of 25 basis points to where we are from where we are now, which is basically 0. Another study has also stated that they will basically they will raise the rates another 4 times of 25 basis points between 2022 and 2023. And that'll just create a lot of volatility in the markets equity-wise because of valuation metrics, which is outside the scope of this conversation, but may be relevant to some of you who see the equity markets going wild, and seems like they're never going to go down. But when rates increase, you may see some pullback in the equity side potentially. So as it comes to our discussions and things that we look at as public trust advisors in Texas classes, we look at treasury yields. A majority of the assets that we manage for clients is held in treasury and highly rated corporate securities. So these data are very important to us when we look at what is the potential earnings for our clients. As you see here, September 22nd was the last Fed meeting where they put out that new dot plot. So the chart is representative of prior to the blue chart is representative of the treasury yield curve prior to the Fed announcement that they expect a rate hike or possibly 2 in the next year. And what you're looking at is the 0 to 10-year earnings, depending on where you put money. So, what we work in is anywhere typically under 1 year, especially in the local government investment pools. In the separately managed accounts, depending on the state, we can go up to 5 years and sometimes 10. So all of these yields are relevant to some part of our business, but for the purpose of this call, we really want to look at that 0 to 1 year number. And while we've seen rates increase slightly, we're not seeing anything in the 0 to 1 year right now, which is basically telling us we are still not earning any dollars on the dollars that we have invested. In reality, the yields are anywhere from 3 basis points to 6 basis points on anything under $1. What is interesting though is the 2-year, because of the increase from the expectations of rate increases, has doubled from 21 basis points almost to 40 basis points. So that is significant increase in rates farther out the curve, and hopefully we will see those numbers start to impact shorter term assets in that 0 to 1 range as time progresses. Just want to check and see if we have any questions right now. Okay, we don't have any questions. This slide is inflation. That's the hot topic right now. Everyone seems to be talking about inflation, whether it's transitory, whether it's running rampant, whether we're losing, in theory, 30% of our purchasing power, which we've heard some statistics say that might be a drastic overreach, but there are certain cases where prices have increased 30% for certain things. And obviously we're seeing that in fuel and certain assets that require chips and et cetera. But what we're seeing on this chart is about an 8-year chart starting in September of 2013 all the way to September of 21. It's the CPI and the core PCE over those years, year-over-year growth or expectations. The Fed Reserve has a mandate to keep inflation at 2% or hovering around 2%. And so you've seen over the last 8 years, they haven't really done that. They've had a couple areas of spike where you've seen inflation increase, but a majority of it has been below 2%. Specifically, the consumer price index increased 4% in September, which means a 5.4% year over year increase. That means everything that you purchase has gone up 5.4% on average. So that is significant to people who are living, who are consumers, and people who live check to check. That is a big impact. What we're also seeing is, let's see here. Used vehicles prices finally declined in September, down 7.7%. Rent was up 1.3%. That is also having to do with a massive movement of the population. Certain areas are getting crushed by influx of population and just don't have the housing available. So we're seeing pretty big increases in rents due to demand and lack of supply, and that is factoring into these inflation numbers as well. I will go ahead and move on to the next slide. However, I do want to just drive home that this is one of the major concerns that we are hearing from our clients, whether purchasing power is going to go down, whether it comes to budgeting for projects, the cost of those projects to be completed, anything that you may have started or done bond issuances for in the past. Are the supplies increasing dramatically to the point where you possibly may run out of money for those projects? All concerns due to this spike over the last year in inflation numbers. This is also just another graphical representation of inflation. And now this looks at it on a much longer time period. This goes back all the way to 1985. And for those of you, obviously it wasn't me. I wasn't working in 1985 to 1989 or even until 1994. But for those of you who lived through and were working through those years, you may remember the massive increases in prices, the shortages of gas, just all sorts of rapid inflation in the 80s and early 90s. That was all kind of monitored and managed by the Fed. And what we're seeing is those numbers kind of went down below 2% for an extended period of time, almost to the point where the Fed was like, we need to bump up these numbers a little bit as well. So we did see rates increasing in 2016 and 2018, 2019, indicating that the market was stabilizing after the last financial crisis, and then obviously COVID happened and the market shut down again. But we do want to highlight with this is the drastic increase in the inflation numbers. We're seeing it's the biggest gain on an annual basis in 3 decades. So the inflation is real. The question is when it goes away. Our next slide covers the Institute for Supply Management, which basically this tells you where we're having problems, where we aren't having problems. When you look at this chart, it's a 3-year chart from March of 2018 up until September of this year, so a little bit longer than 3 years. What these lines tell you is that if it's above 50, the market's expanding, which means there's no inventory buildups, there's no backlog, et cetera, of high inventories. And what we're having here is extremely, in that case, we're having a lot of lack of inventory. There's no supply. So while those numbers are showing that supplies are and consumption's increasing, we're having that supply being replenished, which could cause a future shortage, or if there's not already a shortage on certain things, and it could cause some lines, et cetera. The real focus of this is the supply chain is being disrupted not only by shipping, but also by labor and the lack of employees, and employers not willing to pay what employees want. There are enough cleaning supplies now compared to what there were during COVID. There's enough toilet paper in theory. There's enough, paper towels, but the problem is transporting them to Costco, transporting them to the stores. Everything's there, but there's no workers to take them from end to end. So transportation has been a very big hindrance to the supply chain. Another impact, the labor market. I'm sure we've all heard there are 11 million jobs in the United States that are unfilled. What this chart really focuses on is the unemployment rate from 2008, which was the last financial crisis, to current. If you see on the chart on the left-hand side, there's a red area there. That is the last recession, the last defined recession. We're about 5 million jobs short from where the pandemic started. Jobs reports are coming in lower than expected. It was 194,000 in September. It was expected to be about 700,000 for the same month. So people are not going back to work, which has been, again, creating more of those supply chain issues because they're having a hard time getting products from warehouses to the shelves. They're having problem getting boats unloaded at the docks and getting them to the warehouses. So there's an entire supply chain disruption due to lack of labor as well. One of the good numbers of this, though, is the unemployment is back below 5%. We have a 4.8% unemployment rate, which is in line to an average over the last 15 years. The question is that while we do have 5% unemployment, we have 11 million jobs unfilled, which leads us to the question is how many people are no longer actively seeking employment and have left the job market. And because of that 5%, below 5% number, the labor market is under what the Fed would say is optimal or ideal conditions for them. However, they do not factor in the fact that so many people have left the job market. This is another representation of that same data about the 10.9 million jobs available. 11 million in July. There's no hiring. There are hires available. There are plenty of jobs available. The question is are wages going to meet the expectations of the workers? And if you combine this tighter job market with high inflation, we could see. Those are factors that are actually creating the impetus for the Fed Reserve to begin looking at raising rates. So these are all things that are very important to us when it comes to, what's going on in the economy, what's going on in the markets. And we're going to talk a little bit specifically more about Texas here, and I'm going to let Karen take over here. So Karen, here's your slide on Texas, and please go ahead.
All right, thank you, Ash, so much. I think I figured out the video, so we should be good to go. Again, just opportunity to say thank you to all of you and just being able to present this information to you. So we're going to talk about Texas, but I wanted to share something interesting that I found out while I was doing research on Texas and South Texas. So this slide that talks about the birth rate decline. The interesting information about that is birth rates have steadily declined in the US since peaking in 2007. And surprisingly enough, the births per 1,000 women of childbearing age here in Texas have fallen faster than the national average. So when you're looking at this chart, you can see the spread in the difference between the Texas decline and that of the United States. So from 2007 to 2019, the Texas birth rate declined from 79 to 62 births per 1,000 women ages 15 to 44. And then the national birth rate fell from 69 to 58 for that age group, for that same age group. Although these are only preliminary numbers for 2020, these numbers suggest that the birth rates dropped even further for last year. We don't know the impact that this will have in relation to the labor market here in Texas or the US in the future years, but it's definitely something that we need to keep an eye on. So with that, let's talk about Texas and what's happening with Texas. While you're looking over this slide, I'm going to give you some statistics and some information about the Texas economy. And first, the Texas economy continues to recover from the impacts of the global pandemic, and it remains one of the strongest and most diverse economies in the nation. So some information that's important to know is Texas unemployment rate was at 5.9% in August of this year. Texas gained about 39,300 non-farm jobs over the month of August 2021. Texas gained about 37,500 private jobs in August. The Texas factory activity expanded in August for the 15th month in a row. The service sector activity slowed down in August of 2021, but it still remains higher than the pandemic low point. Retail sales activity grew at the fastest pace since April in August of 2021. So that's great to see. People are getting back out there doing some shopping. Hopefully some people are joining those industries as far as the employment. And also in August, there were more than 39 new project locations announced in Texas by various news sources. And these projects are expected to create $310.2 million in capital investments and roughly around 1,762 new jobs. In July of 2021, Texas exports totaled approximately $32.3 billion, increasing by 2% since June. The week ending September 11th, 2021 saw 15,891 unemployment claims, which still continues to be lower than the highest spike in April of last year. The Texas workforce was 14.1 million as of August, and it was up from 13 million in May. So that's really good to see. Also, hotel occupancies, as far as room rentals and nights sold, the demand for those were similar to 2019 for most of this summer. And air passengers approached pre-pandemic levels in June and July before declining in August of this month or of this year. And since April of 2020, there have been more than 434,000 jobs in leisure and hospitality that have been recovered in Texas. So that's definitely awesome news for Texas. I've traveled a lot in the last year or so, just for work and prior. I saw how slow things were, and just how limited staff they had at the hotels, and it's definitely nice to see more people, but definitely still observing the COVID requirements. So what's going on in Texas as far as the employment? I think it has a positive outlook. Since December of 2020, Texas employment has increased an annualized 4.2% compared with that of the US at 5%. Probably one of the reasons why that was a little bit less was because of the February deep freeze and the power outages that we had here in Texas across the state. This really did cause issues with hiring, and it definitely contributed to that growth gap. Recent activity is strong relative to Texas, and the trend slightly above 2% annually. In August, the expansion was most rapid in two of the largest service sectors, professional and business services, along with education and health. Employment in the oil and gas sector also rose, but it's buoyed by higher oil and gas prices. And I think we've all principally mostly restaurants and hotels, which are obviously more sensitive to the COVID outbreaks. And so generally demand has held up better than the previous COVID waves. And a respondent from the Federal Reserve Bank from Texas Business Outlook survey noted that despite COVID-19 variants, business activities remain strong and is improving. We have no clients that are reflecting a downturn in activity, but they see more staffing issues and product shortages. Similarly, the results indicated that Texas business attempts to hire remained strong in August, with 69% of respondents saying that they sought to add workers. Excuse me. And that's the same as in July. Additionally, firms reported high rates of absenteeism attributable to the spread of the COVID-19 Delta variant and quarantining. While the recent COVID-19 resurgence has slowed the growth somewhat, dimming Texas businesses near-term optimism and raising uncertainty, a healthy level of activity is expected through the end of the year. The Dallas Fed September forecast for 2021 Texas employment growth anticipates the number of the jobs will increase by 4.6% in 2021, with an 80% confidence band of 4.0 to 5.3%. And based on this forecast, there's about 571,800 jobs that will be added into the state this year, and total employment will be 12.9 million in December. This will leave the state with slightly below its pre-pandemic employment level, a shortfall that could be erased by first quarter 2022. So some of the effects that we have experienced, growth has slowed in the last 2 months, but it still remains robust. Supply chain disruption and staffing shortages are the biggest constraints on revenue growth. Unfilled orders and delivery times are still rising. There's a lack of applicants and workers looking for, and one of the reasons why is because they're looking for higher pay that's being offered. And overall, there is a rebound in the economic activity for Texas. And I do want to mention really quick, I did find the unemployment rates for the metropolitan area in Texas, but also in the McAllen, Edinburgh, Mission area. And basically the state of Texas, these numbers showed 5.3%, with McAllen, Edinburgh, and Mission about 8.9% unemployment. And then let's look at just the general growth, and let's start focusing on South Texas. I found some interesting information during my research, so I thought that this would be good to share with y'all, specifically to South Texas. So the 2020 census shows that almost all South Texas counties increased in population over the last 10 years, although the growth in those areas did not keep up the pace with the rest of the state. Even though we had all the growth in Texas overall, there's still a widespread and consistent loss of population in rural areas, as population gains are found in the larger cities, counties, and suburbs. Specifically in the Rio Grande Valley, or the RGV, or the Valley, Hidalgo County posted a 12.2% population gain compared to 10 years ago. Starr County was up 8.1%. Cameron County added 3.6% growth. Willacy County actually lost residents, and they were down about 8.9%. Brooks was down about 2%. Webb County was up 10.5%. Zapata was up 1%. Jim Hogue down about 2%. So you can kind of see where, again, the growth is going more towards the metropolitan areas. And also take into comparing other metropolitan areas, I found some numbers just to give y'all a general idea of what those population changes are looking like. And in Austin, their population was up 18%. Hays County was up 53%. Williamson County was up 44%. And Bastrop County was up 31%. So overall, there is a lot of growth in Texas. I know we're all seeing all the people coming in across the state. And then one interesting fact that I found out about South Texas: if this region were a state, it would have the nation's youngest population. The median age for South Texas, let me get back there, is significantly lower than the state. And 6 of South Texas counties were among the youngest in the state. So just a little tidbit of information. So one of the economic impacts, especially in South Texas, all across Texas, but focusing on South Texas, was the Texas freeze. And what y'all experienced and the impact were infrastructure damage. Many of the roads were temporarily closed. The value of the damage to commercial, agricultural, and aquaculture, ornamental and nursery plants, infrastructure that's already been built, such as pipes, generators, flooding buildings, and the total direct damage could well be over $1 billion. I also wanted to say that when you compare or you take into account economic loss and crop production loss, when those are all factored in, they're still trying to figure out the total amount of loss, but roughly around $2 billion just for the Rio Grande Valley alone. So this is looking at future crops, and some of them may take up to 7 years to recover, especially like the citrus crops. I had watched some videos about the farmers and just, what they were trying to salvage over, once the storm passed, and, a lot of them had everything ready to be harvested or picked. And so all of those crops were destroyed, and they're just trying to figure out what they're going to do in the future. So my prayers are definitely with South Texas. Also, the most costly impacts were really to the natural environment. There was $380 million and counting in agricultural damage. 3.8 million fish were killed in the Laguna Madre, and tens of thousands of damaged or destroyed semi-tropical ornamental plants with damage in the hundreds of millions. And but there was a little positive part in all that is there were 10,000 sea turtles that were rescued. So I'm glad to hear those little critters were saved. And lastly, just some other economic issues that I found that were going on in South Texas. I found some really positive things, and then I found some challenges. And so the positive had to do with education. Over 90% high school graduation rates, which matches the state rate. Texas is looking really good as far as their graduation rates. After high school, there are many colleges for people in South Texas to choose from. With higher education, there's more opportunity for people to attend colleges, because now there's more, there's potential assistance to pay for college, full tuition opportunities. I know UT, Rio Grande Valley, and South Texas College are offering assistance in that area. And so, we'll be able to see even more graduates from the South Texas area. And, hopefully those people will end up staying in South Texas and then adding to the growth, the overall growth of South Texas. Also, technology, there appears to be some technology companies coming into South Texas. I know I read briefly about Elon Musk. I'm not sure everything that's going on with that. Also, Josh earlier spoke about the fiber optic and the broadband, the internet. So Texas Fiber is bringing that to South Texas, and around 350 new jobs. So that's awesome. Then there's also expansion in South Texas, new construction. There's a retail center that I'm sure y'all know about, the RGB Epicenter in San Benito. It's bringing people into that area, jobs, sales tax, new property tax revenue, not for the revenue, or no additional taxes for the residents, but just property taxes and sales tax coming in. And there will be over 2,000 new jobs that are expected to be created in that retail entertainment area. And these jobs are hospitality, retail, specialty services, wellness, office jobs. And it looks like phase 1 is supposed to be starting, I don't know, I saw October 23rd, but that's tomorrow. So, potentially very soon. So those are some great things that are going on in South Texas. Some challenges that South Texas will have, or is having and will have, has to do with water supply, with more people moving into South Texas, the shrinking supply. I also learned about an agreement with Mexico providing water, and that there's been some delays. Also, an aging water system that was designed over 100 years ago. That's definitely causing issues, and looking at the cost to either create new water systems or just repair the current system in the canals. There's been shrinking flows. When you have these open air canals, as much as 40% of the water can be lost in the open water. And the reservoirs are low. South Texas has suffered some drought. There's international treaty issues, and there's also just overall increased demand of the water. So all of these issues are impacting long-term water availability for South Texas, but there are a lot of economic development groups and the Lower Rio Grande Valley Development Council that are really working hard to develop strategies to help with this long-term water supply. And then there's border issues, and really just with that, just really the resources that are actually the cities and the communities are having to provide. So that takes away from the resources that they are trying to provide to their communities. So that's just something that South Texas is dealing with. So with that said, are there any questions for me?
Thank you, Karen. Thank you for that snapshot on Texas. Great to see all the things that are happening in South Texas and so forth. Just wanted to give a few conclusions, and everybody on this call is absolutely welcome to reach out to Karen or I if they have any follow-up questions, since we're not seeing anything in the chat. But the bullet points here, the Fed has acknowledged there is a stronger than anticipated growth due to inflation and the speed and strength of the recovery. The market typically, and has been like this way for the year, is concerned that the Fed is not really taking inflation seriously, or basically saying that it's transitory and not a real effect. The last 2 months, due to COVID, we've had a sluggish job growth, and also people not wanting to go back to work, creating a little bit of tension between employers and employees. The Fed's decision to start tapering next month is going to happen. So we're basically looking at that inflation's a reality, right? So that's the real takeaway here. And again, those rates are going to increase next year or the year after, definitely. So thank you very much for your time. I see Zach is on. I don't know, Zach, if you want to unmute yourself and introduce yourself as well.
I apologize for the technical difficulties this morning, but I was late. I'm glad my counterparts were able to jump on. I've met several of you, and I look forward to meeting many of you more. I will be down in your area, so hope to be able to visit with y'all. If there's anything I can ever do for you, please feel free to reach out. And we certainly do appreciate you allowing us to spend some time with you. Thanks so much.